The US government now spends more money on interest payments than on its entire defense budget. Let that land for a second. And that single number is one of six forces quietly converging on the silver market right now. Forces that, when they have stacked together before, produced some of the most violent price moves in commodity history. Most people watching silver are tracking one or two of them. Very few are watching all six simultaneously. That changes everything about how you think about this metal heading into 2026. Before we go further, if financial strategy like this matters to you, drop a like. It tells the algorithm to push this to more people who need to see it. Now let's get into what's actually happening. Here's what almost nobody explains clearly. Silver has always been one of the most misunderstood assets in the global financial system. Not because it's complicated, but because it plays two completely different roles at the same time. And most investors only understand one of them. On one side, silver is a critical industrial material. Solar panels, electric vehicles, advanced semiconductors, AI infrastructure, defense electronics, grid modernization, every single one of these technologies depends on silver for its conductivity, and there is no cost-effective substitute at scale. On the other side, silver is a monetary metal with thousands of years of history as stored value. When confidence in currencies and financial systems starts eroding, silver tends to move, often dramatically. Now here's where it gets important. Those two roles are not just coexisting today, they are being pulled simultaneously by forces that historically don't arrive all at once. What's building underneath this market right now is not a single catalyst, it's a convergence. And by the end of this video, you're going to understand exactly why six separate forces are stacking on top of each other, and what that has meant historically every time it's happened before. If someone in your circle is watching silver or precious metals, share this before you keep going. What we're covering today goes far deeper than the usual silver content. Let's start with the financial architecture this entire situation is sitting inside. For almost 15 years after 2008, the global economy ran on historically cheap money. Interest rates sat near zero. Governments borrowed aggressively. Corporations expanded debt. Asset prices inflated. Tech stocks surged. Real estate climbed. And gradually, without most people noticing, the entire global financial system became structurally dependent on cheap refinancing. Not just comfortable with it, dependent on it. Then inflation returned, and when it did, central banks faced a problem they hadn't dealt with in over a decade. Rates had to rise into a world carrying record debt, and that combination, high rates plus maximum debt, doesn't create problems immediately. It creates them gradually, through refinancing stress, through rising government interest expenses, through banking vulnerabilities, through declining real growth capacity. The system becomes more fragile even when markets appear calm on the surface. That's the backdrop. Now let's go through the six forces sitting inside it. Force 1. The debt trap nobody can escape. Global sovereign debt has crossed $97 trillion. In the United States alone, the government now spends over $1.1 trillion every year just servicing interest on existing debt. To put that in context, that exceeds the entire U.S. defense budget. And here's the structural problem. That number keeps rising automatically every time old low-rate debt matures and gets refinanced at today's higher rates. Governments don't need a new crisis to face increasing financial pressure. The existing debt structure creates it on its own. And when governments become trapped by debt servicing costs, history is extremely consistent about what happens next. They eventually move toward policies that reduce the real burden of that debt, even if those policies gradually erode the purchasing power of the currency. That process has always benefited hard assets, not immediately, but inevitably. Force 2. Central banks losing room to maneuver. For over a decade, markets operated on a simple assumption. If things get bad enough, central banks will cut rates, expand balance sheets, and stabilize the system. That assumption worked because inflation was low. The moment you cut rates aggressively when inflation is already above target, you risk reigniting the problem you just spent years trying to solve. So central banks are now operating inside a much narrower corridor than investors became accustomed to. Every decision carries a costly trade-off, and markets are beginning to price in that reduced flexibility. When policymakers lose their ability to respond freely, investors start searching for assets that don't depend on policy support to hold value. That search is already underway in ways most retail participants haven't noticed yet. Force 3. Industrial demand that doesn't slow down when rates rise. This is the piece that makes 2026 structurally different from previous silver cycles. In past cycles, silver's bull runs were driven primarily by investor sentiment. Speculators moved in, prices rose. Speculators moved out, prices fell. Industrial demand was relatively steady in the background. Today, that balance has shifted significantly. Solar panel manufacturing alone now consumes over 200 million ounces of silver per year, and that number is growing, not plateauing. Electric vehicle production is scaling globally. AI data center build-outs are accelerating. Grid modernization programs are expanding across multiple continents. Defense technology requirements are increasing. None of these demand drivers slow down because the Federal Reserve keeps rates elevated. They are policy-driven infrastructure build-outs with committed long-term capital behind them. That means even in a slower growth environment, a substantial and growing floor of industrial consumption remains underneath the silver market. When investor demand eventually adds itself on top of that floor, that's where the math becomes difficult to ignore. Force 4, the supply wall. If those demand forces were hitting a market with abundant elastic supply, the story would be less interesting. But silver mining has a structural problem that rarely gets discussed outside specialized commodity circles. A significant percentage of global silver production, roughly 70 to 75%, comes as a byproduct of mining other metals: copper, zinc, lead, gold. That means silver supply doesn't respond freely to rising silver prices. If silver goes from $35 to $60, mines don't simply produce more silver. They produce more of whatever primary metal they were already targeting. Silver comes along for the ride. For genuinely new primary silver supply to develop, exploration needs to succeed, permitting needs to clear, financing needs to arrive, and construction needs to complete. That entire process typically takes 7 to 10 years from discovery to production, which means whatever supply constraints exist in the silver market today will still exist for most of this decade, regardless of what prices do in the near term. That's not a temporary bottleneck, it's a structural ceiling, and rising industrial demand is pressing against it right now. Force 5. Geopolitical fragmentation rewriting the rules of money. Something significant has shifted in the global financial system over the last several years. Countries that once accepted the existing monetary architecture without serious question are now actively building alternatives. This isn't conspiracy thinking. It's visible in public policy decisions across multiple continents. Nations are increasing physical gold reserves. They are developing alternative payment settlement systems. They are restructuring trade relationships to reduce single currency dependency. They are rethinking what it means to hold reserves in assets that can be frozen, sanctioned, or devalued by policy decisions made in another country's capital. This shift doesn't dismantle the dollar-based system overnight, but it does represent a structural change in how nation-states think about monetary exposure and counterparty risk. And historically, when that kind of thinking starts spreading, when the conversation moves from individual investors to sovereign balance sheets, the demand for tangible, apolitical assets moves with it. Force 6. The positioning gap that creates the acceleration risk. This is the one most investors overlook entirely. Compared to any previous precious metals cycle with similar macro conditions, institutional and retail exposure to silver today is remarkably low. For years, capital flowed into technology stocks, passive index funds, private equity, crypto, and real estate. Hard assets became psychologically outdated to an entire generation of investors who had never experienced sustained inflation. That matters because markets don't move only on fundamentals. They move on positioning changes. When a market is small, and the global silver market is genuinely small relative to bond markets, equity markets, or even money market funds, it doesn't take a worldwide movement into silver to create significant price pressure. It takes a relatively modest reallocation. And when that reallocation happens into a market with constrained supply and growing industrial demand underneath it, price discovery can accelerate faster than traditional models expect. This has happened before. The 1979 silver run, the 2010 to 2011 move, both produced extraordinary returns in compressed time frames. Both were largely unnoticed by mainstream audiences until they were already well underway. Now here's what brings all six of these forces together into a single insight, and this is the part I want you to actually remember. The conventional way to think about silver is to ask, what's the catalyst that sends it higher? Most people look for one event, one news story, one Federal Reserve meeting, one inflation report, and that framing misses the entire point of what's building right now. The real question isn't what single event sends silver higher. The question is, what happens when 5 or 6 separate pressure systems converge on a small market simultaneously from different directions at the same time? Think about what that actually looks like. Monetary stress pushing investment demand from one direction, industrial demand growth applying pressure from another, supply constraints limiting the market's ability to respond, geopolitical diversification trends adding long-term structural buying from sovereign actors, a positioning gap that means most of the capital that could move into silver hasn't moved yet, and a debt-trapped financial system that is quietly incentivizing policymakers toward the kind of monetary conditions that have historically driven hard asset repricing. That's not one catalyst. That's a confluence. And confluences, when they arrive in small markets, don't tend to produce gradual, orderly price movements. They tend to produce the kind of price behavior that looks obvious in hindsight and nearly invisible beforehand. Now let's be honest about the risks, because serious analysis requires it. Silver is volatile. Economic slowdowns can temporarily suppress industrial demand. A deflationary shock can pressure all commodities initially, including precious metals. A stronger dollar cycle can slow momentum for extended periods. And silver's reputation for frustrating investors, doing nothing for long stretches before moving suddenly, is absolutely deserved. This is not a straight-line asset. It never has been. Anyone telling you silver goes to a specific number by a specific date is selling something. What experienced macro investors focus on isn't a price prediction. It's probability and positioning relative to the structural conditions underneath the market. And right now, those conditions are more aligned than they have been at any point in recent memory. Not because of excitement, because of the math quietly building beneath the surface. This is why the specific threshold of 500 ounces matters beyond just the number. At small silver positions, price movements feel abstract. A $5 move is interesting. At 500 ounces, that same $5 move is $2,500. Real enough to change how you think about the position. At 500 ounces, you stop asking whether silver might go up and start asking a more important question. What is this asset doing for my overall financial positioning across a multi-year macro transition? Consider how perception changes as price moves across different levels. At $30 an ounce, 500 ounces represents roughly $15,000. Solid, but most investors treat it as a speculative side position. At $50, that same stack is $25,000. Perception shifts. At $75, it's $37,500. At that point, investors don't view their silver position emotionally anymore. They view it structurally, as meaningful exposure to a monetary shift happening underneath the global economy. And once mainstream financial media begins covering a move seriously, the repricing is typically already well advanced. The investors who benefit most are always the ones who understood the setup before the narrative became obvious. The financial world runs on confidence. As long as investors believe debt expansion is manageable, currencies remain stable, and central banks retain control, traditional financial assets dominate attention and capital flows. But confidence is not binary. It doesn't switch off in one dramatic moment. It erodes gradually, through accumulating data points, through repeated policy constraints, through slowly widening gaps between official narratives and observable reality. And when confidence in a financial system begins that slow erosion process, capital starts moving toward assets that don't depend on promises to hold their value. That movement typically starts quietly, often in places mainstream investors aren't watching yet. And by the time it becomes obvious, the early position has already done most of its work. We may be in the early stages of exactly that process right now, not because of any single event, but because six separate forces are pressing against a small market simultaneously, and almost no one has connected all six of them in the same conversation. If this framework changed how you're thinking about silver and what's actually building beneath the market right now, hit subscribe. We cover the macro forces that most financial channels don't slow down long enough to explain properly. Daily updates, no noise, just the picture that matters.